Good evening, everyone. Thank you for joining us this evening on Elite Commercial REIT. I'm Crystal, the Community Manager at ProsperUs. Let me introduce our speaker for tonight. We have Sheldon, CEO of The Manager. She has over 25 years of experience in the corporate finance, financial management, and investments. Prior to her present appointment, she was Portfolio Director of Elite UK Commercial Fund. Ms. Wang was the head of projects at CIMB Real Estate Management Private Limited, where she was responsible for the investment and development opportunities for the CIMB Property Private Fund. Before that, she held various roles such as heading the finance function in maritime companies listed in Hong Kong and Singapore, and was responsible for portfolio investment, divestment, and build to suit activities as the head of investment at the manager of Cambridge Industrial Trust, now known as ESR REIT. Together with us tonight on the Q&A panel, we have Joel Chia, CFO, and also Jonathan Edmonds, the CIO of Elite REIT. ProsperUs is a digital investment service for the millennials. So with ProsperUs, you will not only learn how to invest, but also enjoy curated lifestyle experiences at the same time. Check out our ProsperUs app on Google Play and App Store today. Do follow us on our social media to keep yourselves updated on the latest news. So without further ado, let's start tonight's session. Sheldon, over to you.
Thanks, Crystal. Good evening, ladies and gentlemen, and thanks for taking time of tonight to join us in this presentation. Like what was mentioned earlier, I will be starting the presentation first, and then we'll go into Q&A. So let me just share the screen on the presentation. Can that be seen? Okay. So what we have here is that I will go a little bit into the background of who Elite is, and then a little bit more on our recent results announcement as well. So Elite Commercial REIT is the first and UK-focused Singapore REIT that is listed onto the Singapore Stock Exchange, whereby 99% of our assets are actually led to the AA credit rated UK government. So the REIT owns a total of 155 office assets that are geographically well diversified around the whole of the United Kingdom. So I guess with this, something unique about the REIT is that our leases are all on a triple net basis, what you call the full insuring and repair basis, and then which means the tenant actually manages the cost of operating the buildings as well. And we also have got built-in rental escalations built into our leases. If you look at the map on this particular slide, you will see that the assets are very well diversified across the whole of UK. They are all the little dots, and they're mainly on the lighter grey dots as well. So lighter grey area, which is actually the more densely populated area in the UK. Okay. So I guess the key highlights of our one quarter is actually the results that we have announced recently. What we have done is we managed to have a 36.2% year-on-year increase in our distributable income. We have actually also increased our DPU by 4.9%. We have done something quite unique, which is actually a lease regear program in the first quarter of this year. So 109 of our assets that are being used by the Department of Work and Pensions and also by the Ministry of Defence has now removed the break option. So what happened is that typically we have a 10-year lease, and of the 10-year lease, it's normal for UK leases to have a 5 years break option at the tenant. So what it means is that if they do not break, then the leases goes all the way to 10 years. So what we have done here is we have removed that break option, which means they have no longer have the ability to break it, and all the leases now run straight to 2028. So that means that 85.2% of our leases now has got confirmed income all the way till 31st of March 2028. And in line with that, we have also done a collaboration with the UK government, whereby we actually try and contribute certain percentage of the capex work that they're doing on the building to ensure that it actually boosts the energy efficiency of these buildings. So what we have committed is 14.8 million over the next 3 years to buildings that we own and used by the government. And this is actually meant only for improving the energy efficiency of the building. So I guess with this, well, like I mentioned earlier, 36.2% of our distributable income increase from this quarter compared to last year. And this is mainly attributed by the maiden acquisition that we have done last year. And similarly, that also reflects on the distributable distribution per unit, the DPU, by 4.9%. This is the actual number itself. So for 1Q 2022, the revenue stood at £9.2 million and the DPU per unit stood at 1.28 pence. So these are the respective increases in terms of percentages. In terms of balance sheet, our total assets stood at £527.8 million and our NAV stood at 59 pence per unit. There's a little bit of a drop from the last financial year end number, and this is mainly attributed by the retained earnings that we have on the books itself. Well, this is the capital management chart. So you can see that the debt maturity profile that we have here is that there is nothing expiring this year, but there is debt expiring in 2023 and 2024. So our total debt stood at £225.6 million. Gearing ratio is slightly on the high side, currently at 42.8%. But we will be doing a revaluation, which I'll talk a little bit about later, to reflect the true value of the re-gear exercise that we have completed. The borrowing cost is at 2.1% in all. And we have also hedged, or basically we have got a fixed rate for our debt for 63% of our interest rates exposure. Well, something unique about Elite Commercial REIT is that I mentioned earlier, our tenant is AA credit rated UK government. So it's actually a tenant that has been delivering his promises on all the rental payments. We are always very proud to say that, since listing, we have always been able to report 100% of rental collection 3 months in advance. So that is something that I think during this pandemic period, it's quite remarkable amount REITs, not only here in Singapore, but also in the UK. That's all credited to the strong tenant that we have. The WALE of this portfolio stood at 5.5 years. And the full occupancy rate is reflected as of 31st of March 2020. Now, I have to clarified to say that because we do have reported that one small building, which is Sunderland, that has already got its break options received last year, that property is now currently been vacated, and we are doing the asset management work to relet or other activities on that building. So I'll talk about that later. Okay. What I mentioned earlier, the lease regear. So, in a total of the assets that we have been let out to this main tenant of ours, which is called the Department of Work and Pensions. So Department of Work and Pensions is actually responsible for UK's social benefits, things like pensions, things like unemployment benefits, disabled benefits. So this particular tenant itself is very busy even during the COVID period, because a lot of people has gone out of job. A lot of people are claiming on the government to help them support through the period. So DWP itself, all the assets remain open, and they are actually in business throughout the whole COVID period, despite all the lockdowns that we see in the UK. So of the portfolio that we have with them, we have got 117 assets that is being led to the DWP that has got this lease break cost coming up in 2023. So we managed to actually negotiate with the government and also to get them to remove the break options from these 108 of these assets, leases in these assets. And with that, it means that the rental income from this portfolio is secured all the way till 2028. Now, there are 11 assets which the government originally were thinking of. The space that they need is actually a bit more than what they require. So there was some discussion and negotiations on these properties. So what we have done is that we have actually renegotiated the rent for 11 of these assets. And this new rent rate will kick in 2023, April. So what it means is that there is a slight reduction in rental. But however, having said that, we will see a reflection of rental increase first. So I'll come a little bit to the rental escalation that we have in our portfolio later, on explaining how that works. So except for these assets that has been announced, we have only got one property which the government has not yet decided on the outcome of it. That one we will come back to the market. It's not a big property, but it's a property that they have yet to decide. Other than that, we have got certainty in our portfolio, and we do see that because our escalation is linked to an inflation rate. So that means that, current situation actually benefits us in terms of rental escalation that's coming up next year. The other asset that was we have mentioned was actually the Ministry of Defence assets. So similarly, the lease break option has also been removed from this particular property in Blackpool, and that runs straight to 2028 as well. So I mentioned that there are 8 assets that DWP is moving, has already served the break options. So that represents about 4.8% of our contractual rental income as of this year. The asset team in UK, our asset team in UK, that is actually headed up by Jonathan as well today, has joined us. It's actually working extensively onto what are the potentials of these assets. What we want is that we want to bring the best potential for the REIT's perspective, whether being a relet or other usage. Like I mentioned earlier, John Street, Sunderland has been vacated. The other property that has previously been served a break notice before this negotiation was Sidlaw House in Dundee, that is actually used by another department itself. So these 2 properties are currently being marketed as well. So but Sidlaw House is still not at the end of the vacation period yet. So we are currently still collecting rental on this particular property. Oh, by the way, the 8 properties that they have served the break options, the leases will continue to run, and they're still in operation, which means that we will continue to collect rental for these assets for another year. In the meantime, we have this 1-year period to work on the alternatives for these sites. So like I've mentioned earlier, on these sites that has been vacated, a few potential options that we could actually look at. It includes, of course, primarily reletting as an office space to another office users, or it could be disposed if it actually creates a better value for the REIT, where we can recycle some capital, or alternatively, it can also be converted to other usage. So in the UK, especially in England and Wales, there is the ability for properties to be converted into residential without having to go through a long, tedious development process. So these are some alternatives. Not saying that we are going to be a residential player, but it also means that it can actually fetch us a different price should it be considered to either be redeveloped or disposed of as for other usage. So this is just some of the examples. So basically, the manager is now actively working on these portfolio and trying to provide better outcomes to the unit holders. So we'll come back to the unit holders once the firm position has been reached on the assets. So with this lease re-gear exercise, what we can see from this particular chart now is that we have moved the lease expiry profile all the way till 2028. Previously, you will see a tall tower in 2023 that has been shifted out. Now, having said that, the manager is also cognizant that there is a bit of a high concentration during the 2028 period. It is something that the manager is working on over time to sort of like flatten out this particular chart as well. So, when we look at new assets to buy, we will also consider the lease expiry profile of the new assets, even talking to our existing tenant to see if there's any potential of, extending the leases or as such. So these are the things that the managers are doing now. Now, coming to what I have mentioned earlier, which is actually the built-in rental escalation in our portfolio. So in our portfolio, there is the leases are signed on 10 years basis. What it has embedded in the lease is that there is a built-in rental escalation clause. And how this clause really worked is that it will compound the CPI every year for 5 years, starting from 2018. So majority of the leases has got this structure. And because the leases were originally signed back in the 2018, it has got this compounding effect over the past 4 years. And depending on what is the outcome in this final year, that will determine the new escalation. However, having said that, there is a floor and cap to this particular CPI index growth rate, which is a 1% minimum and a maximum of 5%, which means that if the CPI is below 1%, we will at least get a minimum of 1% for that year. And if the CPI goes beyond 5%, like what is happening currently, we will have a maximum of 5% increase. So like, for example, in 2020, during the COVID period, you will see that CPI has gone below 1%, but we will at least compound a 1%. So having that in mind, we do know that, coming up by 2023 April, what is the kind of escalation we are expecting? So this particular table shows or basically gives an illustration of what is going to happen to the assets that I've mentioned earlier that has gone through the lease regear exercises, and also those that are used by DWP. So you can see that, some of these have got straight 10-year leases. Some has actually got the lease breaks clause removed. So what it means is that all these leases that are remaining with the portfolio will get this uplift. Now, like I said, it has been compounded for 4 years, and depending on the prevailing CPI growth at the end of this year, so that will determine the growth at the final growth of the CPI-linked inflation rate linked rental. So we see that potentially we are having a minimum of 11% and a maximum of 15.4% increase next year. Well, with the high inflation rate currently hovering around the UK and as well as other parts of the world, we do expect that it's going to head more towards the higher region rather than the lower region. So there are properties that has got some lease adjustments. There are properties that has got vacated. What we can say is that we are expecting the rental income to be better than current. And having said that, we have also not factored into account any new rental that we are going to collect from the few properties that the government has actually served the brakes. So which means that the rental income should technically be higher than what we have stated here for the assets that are led to DWP and the Ministry of Defence. Coming to a hot topic or flavor of the month that people are talking about, which is the sustainability efforts. We have published our first sustainability report together with our annual report in April. Now, being a Singapore REIT that is actually having all its assets in the UK means that we not only looked at the requirements and the governance that is stipulated in Singapore by the MAS or SGX, we also have to consider the sort of like the frameworks and other things that are happening in the UK. And the REIT is following and very closely to what the UK government is envisaging to do, which is to reach a by 2050, we can actually have a net zero sort of like a net zero carbon emission kind of an objectives reach. So having said that, we are complying with all these standards that is stated here, that we are reporting in our sustainability report. We have got clauses within the lease agreement that requires the tenant to provide with us with all the their usage and stuff. Hence, we are also able to calculate the amount of energy usage and things that they have actually managed the building in our report as well. In line with that, we have also formed the Sustainability Committee, which is the governance structure that's shown here. It is actually headed by our own chairman itself. So we do take sustainability seriously in our REIT, and we want to make sure that we are able to provide a building that is more efficient and more energy efficient to our tenant. So, with that, we have actually started the journey. We now work very closely with our tenant sustainability team as well on a regular basis to understand their needs and requirements, and also to position ourselves in the future. So like I mentioned earlier, we are going to contribute £14.8 million over a course of 3 years to our tenant. This is not the only amount of money that they're spending on the building, because it's an FRI leases. So a lot of the CAPEX work and also the required for them to do for sustainability, efficiency kind of work are also paid by the government. This only constitute to a fraction of the cost, but we want to work hand in hand with them and show our commitment to ensure that the building needs to be of better sustainable, to have a better rate on sustainability as well. So it will be over a pool of agreed works, and this could include things like double glazing of windows, the boilers, the lighting's efficiency. So this flows into the basically will help improve the quality of the asset in the longer run, and it makes it more relevant and more appealing to tenants in the future as well. So overall, if we look at the UK economy, they have opened up the economy much earlier than us. We do see that the economy has been improving, and it has actually grown back to better positions in terms of reflected in their GDP growth. However, having said that, we do see that with the current situation ongoing in the Europe, with the Ukraine and Russia war that is actually still happening, we do see that inflation is kicking in quite substantially into the region. So CPI has really rose. It has actually hit 9% as of April reporting. The government is expecting that this will go even higher towards the second half of the year. And to counter that, we also see that Bank of England has started to increase its rates. So, interest rates has been increasing over the past few quarters. The last was actually up to 1% now, which was reported in May. We do expect that there will still be some more rates hiked in this coming few quarters. So that will definitely be the overall sentiment in the UK itself. But people are getting back to work. The government is asking all its employees to go back to its office as well. So the industry, in terms of commercial usage or in terms of the government used buildings, it's actually being well occupied at this point in time. And John is actually on the road currently to see some of our buildings. So definitely things that he can share with you. So in order to hedge against this rising inflation rate, what we see as a REIT, what we have is that we have got lease stability and also income visibility for our portfolio. We have our leases that are on FRI basis, which means that the government is responsible, or basically the tenant is responsible for all the maintenance and repairs of the building. We have got CPI linked increase in our rental escalation built in. So that will help us cushion the high inflation rate, and that's going to kick in April 2023. Our assets and liabilities are all denominated in GBP, so which means that there is a natural hedge in terms of the currency for us. Investors can choose to receive the dividends in GBP and also in units itself. That will then not be the impact of this forex exchange will not be that great if you believe that the currency has a longer hold period time. So I guess this is up to individual investors. And largely, we have got 63% of our interest rates on the fixed rates. So that insulates us from the increase in interest rates on the whole portfolio. But of course, the balance that is actually not fixed will have to follow the fluctuations of the interest itself. So having said that, I guess we have managed to be one of those REITs that has got very secure distribution. We have always been collecting 100% of rental, and hence making our distributions 100% to our investors as well. This chart basically shows the ups and downs of the share movements. So I would say that Elite Commercial REIT debuted just before the onset of the COVID pandemic in February 2020, has been able to perform relatively stable, and it has also been performing above the ASREIT's index throughout the period. Now, having been listed just before COVID also means that we have got limitations in terms of reach out to investors on a face-to-face basis. All the events that were actually previously done in the REIT space has been held back, but now we are seeing more events coming back up. We are always very keen to talk to investors like yourself. So, events of such are things that we have been trying to reach out to our investors and trying to get more people to understand Elite Commercial REIT. Having said that, we have got 4 houses that's covering us, CIMB being one of them that has been covering us since day 1 of listing. So I guess that is the short snapshot of our share performances. And in terms of our efforts over the past 2 years, we have been accredited with recognition for corporate governance, for financial management, and also in terms of the aspects on reporting, in terms of things like tax management. Something that is quite unique of us, which is not spelled in details here because it happens last year, was that we have technically listed the REIT onto the TSE, which is the International Stock Exchange, and that allows us to have the benefit of all UK REITs compared to other UK REITs in the UK. So it's a tax consideration restructuring. It also means that we no longer have to be having an increase in corporate tax. We have got a structure that is very efficient. So we have reduced the corporate tax rates of 19% to just a withholding tax on dividend of 15%. So that's what has been recognized by the tax operations and optimization awards that we receive I think this happened in the beginning of this year. So with that, also annual reports is the other one that we have been very pleasantly surprised with the awards. We always aim to strive to communicate better to our unit holders, and this is one of the ways that we try and communicate, which is through the annual reports and also our sustainability report as well. With that, I think a key thing is what's next. Well, we always want to grow. Elite Commercial REIT, being one of the youngest REIT here, is also quite small in size. We would always have the ambition to grow into a much bigger size REIT. Hopefully, we can get optimal market cap, whereby more investors will look at us as well. We have got a few pipelines. One is the ROFR pipelines that the sponsor has for us. So there are certain assets that has been bought by the sponsors and kept on books, waiting for us to be ready to acquire them in time to come when we are ready. Also, we are also looking at third-party acquisitions, which is to buy from the open market. Government-led, or basically government leased buildings in the UK is freely traded. Government don't usually own the assets these days. They have really gone asset light back in the 1990s. So it's a very active market for these long leases to be traded in the UK. So apart from that, we have got very proactive asset management team that has been working on the asset. So we want to formulate the best outcomes for our unit holders for the assets that we have. So the team itself works very closely with the government tenant to make sure that their requirements are being met. So all in all, we will also be working on these green collaborations even more to more tenants as well. So hopefully not only just DWP and MOD, in the future we will be able to talk to other of our government tenants in terms of these aspects and try and incorporate this into our portfolio to make sure that our properties remains relevant in a much longer period of time. So with that, I think I come to the end of the presentation. We'll then invite John and also Joelle to join us.
Thanks, Xiaodin, for the presentation on Elite Commercial REIT. I believe we have a few questions from the floor. Can we take a look at the first question? The first question is, it's noted that Elite's DPU has dropped over the last 2 quarters. What is the reason for the reducing DPU, and how is the management addressing this?
Yep, I can take this. Thank you for the question, Julian. So, okay, so long and short of it, I wanted to also show you all a screen that was prepared. Hang on. Oh, I can't seem to share screen, but okay, never mind. Basically, our distributions are distributed on a semi-annual basis. So while we file or we report quarterly distributions, we distribute on a semi-annual basis. So if you look at our website, we actually show that in the last four halves, our distribution increased from 1.95 pence to 2.49 to 2.63 and 2.8. So actually, from a distribution point of view, we have been showing increasing trends at every semi-annual basis. In this particular quarter, we reported 1.28 pence. The reason for that is because we have mentioned to investors ahead of time that the manager will be converting the management fee received in units to be received in cash. So just to take a step back for the benefit of investors, in Singapore REIT accounting rules, there are certain items that can be added back to increase your distributable income. And one of that is actually management fee collected in units. However, the flip side to that arrangement is that while you have an elevated distribution per unit, it dilutes your unit holders pool because all the fees are then generated in units. So your unit pool keep increasing. So from a manager's point of view, we wanted to achieve a sustainable outcome for unit holders. So by collecting our fees in cash, while you report a lower DPU per se, but from an effective point of view, your unit holder pool doesn't keep increasing. So in other words, your share of the underlying asset pool will be similar or stable over time, rather than the pool being diluted over time. And that is largely what is causing the slight dip in DPU when we reported this quarter's distribution. We also face a bit of a slight headwinds from the increased borrowing costs, notwithstanding we hedge 63% of our interest rate exposure. There's still 37% that is subject to the vagaries of the interest rate movement. And as you know, the central governments around the world today are hiking rates to combat inflation. So inflation to us is a double-edged sword, right? On one hand, it helps to increase the revenue line because after 5 years, we are expecting a minimum of 11% escalation to 15.4% escalation. So our top line benefits greatly. But of course, on the other hand, there'll be a borrowing cost item on the P&L that will be affected by the increased interest rate. So, but overall, when you see the bigger picture, the revenue is a larger line item and it's escalating at a much higher rate, vis-a-vis the borrowing cost, which is a smaller line item and it's escalating at a much smaller rate. So overall, the performance of the vehicle going forward should be a net positive from this inflation and interest rate dynamics. Yeah.
Thanks, Joel. I hope this answers Julian's question. We have another question from Jerry. Can we take a look at the question? After making the choice to list in Singapore, why do you insist that your units are traded in British pounds and not in Sing dollars for the retail investors? And bearing in mind that retail investors do receive the distribution in Sing dollars through CDP. So by making the decision to trade in British pounds and not Sing dollars, can we assume that the manager are prioritizing the needs of the institutional investors over the interest and convenience of the retail investors?
I think I can take this and Sheldon, feel free to supplement. So actually for this, do note that in every investment product, when it's created or generated, it has been market tested. So at the point of time when Elite Commercial REIT was going for IPO, we did actually test this currency preference. And if you notice, not just us, a lot of foreign listed REITs, or listed REITs with foreign assets tend to lease with a different functional currency than SGD. That's because it is actually more efficient from a cost perspective to have your asset and liability that is in a foreign currency to be your functional currency, so that you don't have an asset liability mismatch from a hedging perspective. And when you remit the money back, you don't have to necessarily incur translation costs. So those those REITs with foreign assets, but they list in SGD, essentially what they did was that they have embedded or they have to pay the translation cost of running their business in NGT. So in other words, on paper, while you might not see that, oh, my dividend changed because of FX, but actually it's embedded in the dividend you're receiving already. So hedging comes with a cost. So REITs with foreign listed assets tend to, and I'll dare say majority of them would actually be listed in the foreign currency they are in. And therefore, when it's translated back to Singapore, it doesn't have a translation loss. And I would also want to go one more step to say that CTP actually protects the interests of investors in Singapore really well. So upon receiving dividends, investors actually have three options. If you do nothing, by default, you will get your dividends in SGD. The manager would take the declared dividend rate of certain amount per pence per unit, and we'll go to an institutional bank, and we will negotiate for the best possible FX rate from a collective basis. And then we'll pass on the Sing dollars to CDP to distribute to unit holders. So the Sing dollars that you receive from CDP was actually a collective effort by the manager to swap on your behalf. For other investors who don't mind receiving in pounds, which there are a big portion of our investors who will do so, they would then receive their distribution in pounds. And of course, those who choose to reinvest their distribution in scrip will then receive in scrip. Just by a very simple statistical color of the distribution collection rates, majority, I would say a good 6 out of 10 investors still choose to receive their dividends in pounds. About 1.5 investor in out of 10 will receive their their dividends in units, and then there will be about 25% of them who will receive in SGD. So if we were to serve the unit holders per se, I think the current functional currency of GBP and declaring dividends in GBP still serve majority of the unit holders. And one more thing that I want to add is that some foreign listed REITs, REITs with foreign listed asset has attempted to dual lease or have a dual currency on the exchange. That means, in other words, they have a functional currency or primary currency that's foreign, and they have a Singapore counter. We notice that typically the second currency is very thinly traded and doesn't have a lot of receptivity. So that's why we also realize that actually it's better to stick with one functional currency, trading currency, instead of splitting the liquidity dry from two currencies point of view. Yeah.
Thanks, Joel. Charlene, do you have anything else to add on?
Sorry, he was muted. Yeah, I guess I pretty much similar to what Joel has said. When we first decides to list the vehicle, we did actually went on a roadshow and request investors' opinions as to whether is it better to be SGD vehicle or a pound. Having said that, I would say that we are REIT managers. We are not experts in hedging of currencies, I would say. So in terms of the property wise, because the expenses are in pounds and the revenues are collected in pounds, it do make sense for us to keep it as a pound vehicle. In future, if there is actually a need and we do see that there is potential of having a different currency, for example, like what Joe has mentioned, some REITs have done, we can consider that. But at this point in time, we do, based on our study and analysis, we do think that the second listed currency usually are too thinly traded to justify the additional efforts or costs that's involved to do it.
Thanks, Sheldon. I think we have another question on DPU. What is the impact every 1% rise in the interest rates on the DPU?
When we simulated this sensitivity analysis, because we are 63% hedged, so a 1% increase in interest rate will affect about 3% of DPU. So in other words, every 1% of 100 basis point of interest rate going up, your DPU would decrease by about 3%, roughly. Yeah.
Thanks, Jonathan. We have the next question from David. Will Elite remain UK focused and office focused, or will it venture outside UK and into other property segments such as industrial or student accommodations?
Hey, Sheldon, shall I take this one?
Yes, please. Yes.
Yeah, I think our primary strategy is, to be an office-focused REIT, and also focused in the UK. The reasons for that is that the strategy that we've adopted has put us in quite good, good stable position, particularly over the last few years, as there's been a considerable amount of volatility in across the global economy for various reasons. So particularly having a sovereign tenant, who are paying us 99% of our income and who have paid us in full and on time every quarter since we listed, sets us apart from other REITs. So we think that's a good strategy, and also one that we can continue to grow with. There is a large amount of government leased property available to acquire in the UK, so we see plenty of scope for growth as well. One thing that I would say is that as the tenant vacates a small handful of our assets, we do look at the potential for those assets to be either retained as office buildings or in fact converted to other uses. And so when we're appraising these sites, we'll be looking at the potential for residential conversions, as Shaldine mentioned during the main part of her presentation, but also student housing, for data centers, for industrial logistics. Actually, there are a variety of different uses that our assets have potential to be converted to. So for the time being, our strategy is UK focused, office focused, UK government focused. But that's not to say we don't look for other opportunities as well.
Yeah, maybe just to add on is that, apart from the current assets that we have, something quite unique about Elite is we do have quite a huge land bank in our REIT itself, which we can actually develop either as offices or as other usage when the needs arises. So there are potentials. I would just say that in the near term, we are keeping to what we are good at doing and focusing on what we have been doing. But in the long run, we are always very objective. We would evaluate on a time-to-time basis, evaluate what's the best outcome for the unit holders, and we'll definitely then come back again to the market.
Thanks, Shaldine and Jonathan. Let's take a look at the next question. What effect will the Ukraine war have on the property valuation and hence Elite's NAV?
Yeah, maybe John, you want to take the valuation part?
Well, it's in terms of the the effect on valuation. The Ukraine war is having a big impact on inflation and borrowing costs. I think those are the primary impact. So as Joel has sort of been through in quite some detail earlier, that we are as a business reasonably well hedged against rises in interest rates through the rent review mechanism in the majority of our leases, which are pegged to inflation. That will be taken into consideration by valuers who will look at the leases, valuers will see that the rents are going to rise in next year, and that will obviously be seen as a positive. Now across the broader UK, actually rental values are rising in lots of markets because simply because of the cost of construction, the cost of refurbishments is rising rapidly as well. And actually that means that rents are likely to rise as well, in the next few years to keep up with cost inflation. So I think the direct impact on as far as we can see it of the war in Ukraine is that it's probably net neutral to us. We don't expect a significant fall in our valuations as a result of that. Our business is built to be counter-cyclical, so it performs slightly better than other companies in a recessionary environment, and obviously there is some potential for that. And the reasons are that in a recessionary environment, there are greater numbers of job losses, and our assets are largely used in the UK to help people get back to work if they've lost their job, or a large number of properties are. So in that sense, we're also protected. So in short, I don't think the war on Ukraine should affect our valuations or our NAV.
Thanks, Jonathan. We have another question from David. Is Elite in any of the indexes typically used by institutional funds for their investment allocations and decisions?
I can take this very quickly. Elite is, from a market cap perspective, is still quite small. But from what we understand, that we are in some of the micro cap indexes, and most of the index that we are in, we actually did publish in our annual report. So do take a look at the annual report to understand it. The ones that institutional investors invest in are the mid cap or the REIT indexes that currently we are still aspiring towards. Typically, the yardstick for achieving that is two things. Number one is the market cap of the vehicle, which we understand to be about dollars 1 billion in total. And the other one would be the ADTV, which is the average daily trading volume, reaching a certain level. So that's the reason why we definitely look forward to your support to help to drive the ADTV as well. As you buy, the ADTV will increase. And over time, as we grow, as what Xiaodin has mentioned very clearly articulated in our strategy, we want to grow because growing and increase in size will increase the diversity and the sources of funds, and therefore improve your market cap and your trading volume in turn. So everything is in spiral. So it's a chicken and egg issue, and we realize that, and therefore we are working towards that.
Thanks, Joel. We have another question from David as well. What role does the Malaysian sponsor, Sunway REIT Capital, hope I pronounced it correctly, play in the long-term development of the REIT, or are they just a silent shareholder?
Okay, maybe I could take this. I've been working with this group since they came in during the private fund stage. Now, Sunway REIT Capital is a Singapore entity of the Sunway Group. They were set up in Singapore and to actually help the group to look into recurring business. So the REIT being one of them is definitely something that the Sunway Group is trying to grow. Now, they are not only just a silent investor, they also owns a percentage in the manager. So Sunway Group has been helping us in terms of various aspects. I would say that other than just being an investors, they have also been able to link us up or give us, sort of like guide us along with potential other investors that they have introduced to us. And also in terms of helping us like the financing part on, liaising with banks, trying to get better rates. So I guess all in all, although Sunway are not owners of certain commercial assets that in the UK, they do have portfolio in the UK. They are more into student accommodations there, but they also invest together with other sponsors on the private funds to help us build the pipeline. Now, why are the private funds set up rather than the REIT going in? It's more because of the size of us and also for us the ability to fund it and also do equity fundraising to acquire the assets. Now, in the UK, assets are transacted at quite a efficient or fast manner, and particularly the assets during the COVID period. While we have just absorbed the first major acquisition, listing in 2020, maiden acquisition in 2021, we are actually still digesting the portfolio that we have. So in the meantime, what the sponsors could help us to do is that they try and help us amalgamate some of these assets where we are not in the best position to go out and massively acquire yet, and waiting for us to be ready to acquire. So that is one thing that the Sunway RE Capital is actually doing to help us in that aspect. So I guess all in all, they are not in the management role, but they are sitting on the board level. They are also investors in the fund itself.
Thanks, Sheldon. I think we have a few more questions. Can we take a look at the next one? Along with increasing inflationary pressures, central banks have been hiking interest rates to combat rising prices. How is Elite Commercial REIT hedged against this trend?
This one is something that I've covered in my explanation earlier. So basically, we have hedged about 63% of our total interest rate exposure. However, as any honest REIT manager will tell you, you are as good as how long your hedges last. So when the hedges roll off, you need to reprice the loans and everything. So for now, we are 63% hedged, and our all-in borrowing cost has been quite stable at about 2 to 2.1%. Yeah.
Thanks, Joel. Let's take a look at the next question. Following this scenario, what are the priorities of the management for the REIT over the next few years?
Okay, let me take this, and my team can jump in later if there is anything to add on. I guess for us, the key thing is that we have just managed to completed one of the major exercise, which is the lease regear. So that sort of insulates the portfolio in terms of any major fluctuations coming up in a year's time. Having said that, like I've also mentioned in my presentation, the REIT is still small and young. We want to grow, and also we want to, with the objective to hit the sweet spot for a lot more investors, which is what Joel has mentioned earlier. I think it's the if we can have a market size reaching 1 billion Sing dollars in terms of sort of like the indication. So having said that, that means that acquisition is always on the radar. It's just that what kind of properties, how are we going to acquire? We need to structure it so that it benefits the REIT at all. So that is the job that we are focusing in the very near term, definitely. Now, over the next couple of years, I think apart from just growing, John's role on asset management is also very critical. So he's not looking at just at properties. So he actually got a big burden up in the UK. So just to share, we have relocated Jonathan back to London last year. So we have got an office on ground in the UK, working very closely with our tenant in the same time zone. We have also built the team with very experienced asset managers and asset managers that has been working on this portfolio, with this types of portfolio, and also with linkages to the respective government departments are actually recruited onto our team. So apart from acquiring, second is how to manage them, how to make sure that even though if they are on FRI leases, what can we do with the asset to make it better in the future? So the collaborative efforts that we actually come up with, based on what we discussed with DWP, or basically our main tenant, they're saying there is an innovative suggestions that probably none other landlords has come to them yet at the point where we actually went to them on this structure. So we are the largest landlord to this particular department. So we want to collaborate with them in a much better way to know which are the areas that they would like to grow in the future, which are the assets that they would need much better in the future as well. So asset management role is also very critical to us. So hand in hand, these will be two main tasks. Of course, coupled with that is all the supporting functions in terms of fundraising, in terms of both equity, debt, investors outreach. I think these are just the basic things that we all need to support this structure. So grow is probably our key thing. Grow, maintain, basically to in our portfolio to ensure that they're good, and also incorporating all the sustainability efforts into the profile itself.
Thanks, Sheldon. Not sure if Jonathan or Joel has anything to add on.
No, I think Sheldon has covered it. Growth and tenant engagement, which I think growth is probably comes first because that's been our goal for a while. Tenant engagement. We've had a significant success already this year. We'll continue to do so. As Sheldon's mentioned, we've set up a really good working relationship with our primary tenant. That's a really important step for us as a business, and we'll continue to work on that as well.
Thanks, Jonathan. I think we have one last question for tonight. One nightmare for retail investors is private placement at discounted prices to institutional investors. Given that current gearing is already fairly high at 42.8%, do you see private placements happening?
Okay, so very good question. I guess one of the things that I want to raise is that whenever we have to finance acquisition, there's a plethora of tools available to the management team. And depending on the market environment and conditions, we would then assess which tools would be the most suitable to fund the acquisition. So David's concern in this particular question was on the fact that, retail investors might feel that, hey, you are pricing at a discount to VWAP and we feel left out because the private placement actually go to institutional investors. However, we also want to demonstrate, we have demonstrated track record, like when we did our maiden acquisition, the market volatility wasn't that good. And the share price was actually trading below our initial IPO price. So to protect the interest of unit holders, we actually formulated a plan B, which is to actually complete the acquisition without going out to do fundraising. We just use our existing internal resources, that means having more debt, etc. And that's the reason why our gearing was a little bit toppish now. That means it's slightly higher than what we like it to be. Therefore, what we wanted to share is that we chose to take care of investors' interests, not necessarily diluting their NAV or placing out shares at too cheap the price or a much lower price than what was done in IPO, because we are fresh from IPO anyway, right? So that's why we chose to take the other step, which is complete the acquisition with our debt sources. So from a track record perspective, the manager does take care of unit holder interests. We don't necessarily choose to take dilutive placements to the detriment of another group of investors. And like I say, whether it's a private placement, rights issue, or even a structured product like perpetual securities, there are actually ways to actually manage the gearing in the mid to long term. And the manager will actually evaluate and assess the market environment at the point of time when the fundraising to be done, to make sure that we do what's right for majority of investors as best as we can. We also acknowledge and we are cognizant that we can't satisfy everyone, but we do our best to make sure that we do the right things by the investors.
Yeah, maybe just let me add on one point about the gearing as well. Just a point to note is that when we reported the gearing is based on the valuated amount, valuation that was done as of 31st of December 2021. That was when we did our financial reporting. Now, the lease re-gear exercise was completed in March this year. So when the valuers are doing the valuation as of end of last year, it doesn't have the benefit of the full picture of what is being retained. So certain discounts or has been actually factored into the valuation itself with some certain assumptions that are built in. Hence, the manager is actually suggesting that we are doing a mid-year valuation. And of course, that will reflect the true value of the asset as of the mid-year. And of course, like what we have discussed earlier as well, the situation in December, and now it's probably slightly different. There is a war ongoing. There's also inflation. So all in all, the end of the this month's valuation should then reflect a true value of the portfolio to show the real leverage level that we are in, rather than whatever we have reported in December. I'm not saying that it's not wrong. It's just that it is correct at the point in time, but it has not taken into consideration the major event that we have actually done this year.
Thanks, Xiaodin. Maybe just one last question to wrap up tonight's session. So any upcoming acquisitions that you would actually like to share with the investors?
Well, like I said, we are always looking. Well, we'll definitely come back to and let the market know once everything is in place. But we would hope that we can do something by the second half of this year. So my team, it's actually actively looking at some potentials. Yes, we are looking at acquisitions. But I can't reveal more than the details much more, other than the point that we are looking. So definitely, once we have got more confirmed information, and we're in the position, we'll definitely quickly let the investors market know as well.
Thanks, Xiaodin. So those who are actually tuning in tonight, maybe can keep a lookout on Elite Commercial REIT on their upcoming acquisitions. So thank you, Xiaodin, Jonathan, and Joel for tonight's session. We hope you have enjoyed tonight's session and managed to acquire some key takeaways, and to actually help us better understand what we can actually do for you better in future sessions. Do scan the QR code shown in this slide to complete a short survey. Thank you, Xiaodin, Joel, and Jonathan again for tonight. And good night, everyone.
Thank you, and good night, everyone.
Thanks, and good night.
Thank you.